Hello everyone. In this video, we'll be discussing family trusts, which are also known as discretionary trusts. A few disclaimers here. This is not financial tax advice. You really do need to be speaking to a trained professional, qualified professional, to give you the right information and the right guidance with this, because it's not made specifically for your unique situation. Okay? Now, this topic is quite important to me personally, because I've seen clients who have gone out and done things themselves, set up things themselves, or they've had bad advice from, unfortunately, other professionals, other accountants, and they get whacked with a great amount of tax that they need to pay, either throughout the time that they're using this structure or at the end when they are about to exit the business and sell it. Okay? Again, I've seen this many times. People try to save a little bit of money and they end up paying so much more. And obviously that's missed opportunities in terms of money that can be contributed towards your retirement, money that can be given to charity, or that can just be used on your family, maybe some holidays or renovations, so on and so forth. Okay, so let's jump straight in. We're going to be talking about the cons and the pros, the disadvantages and the advantages. In no way is this comprehensive or an exhaustive list. There are other cons and there are other pros of using this type of structure. Let's look at the first con, or the first negative. The first one is the losses are trapped. What does that mean? That means if you have a loss in the entity, whether that is a capital loss or an income revenue loss, you can't pass that on to another entity that has a profit and offset the amount. Offsetting means you're effectively wiping off those two against each other, so you're reducing the amount you're going to be taxed on. The next one is tax rate. The trust is not assessed in its own right on tax. The negative here is where there is no distribution, the trustee is taxed at the highest marginal tax rate plus Medicare levy surcharge. That's quite an expense. So you completely want to avoid not distributing income or capital to a qualified beneficiary. The next one is the research and development concession. What is R&D? Research and development is a rebate that's provided by the government, or Industry Australia, to help businesses to conduct research and development, thereby coming up with new services and new products. The trust does not have access to this. A company has access to this. So again, that's another downside of using a trust structure. Another problem is no new members can be admitted into a discretionary trust. If you do admit new members, that causes resettlement. And with the resettlement potentially comes paying stamp duty. But that's another topic outside the realm of this video. And that's something we might cover in another time. Okay. The next one is, because there's no new members, it's difficult to raise equity in terms of, when we compare against the company, where you can issue shares, people provide money for those shares and use that money to fund the business, the venture. The last one is unlimited liability. Now, this is particularly the case where you do not have a corporate trustee. If you have an individual as a trustee, a creditor can go after all the property of that particular individual. So we like to always use a corporate trustee when we come to set up a discretionary trust. Now, if there's foul play involved, then even a corporate trustee might not help the situation. Okay, it's all relative and it depends on what the situation is. We're going to move on to the benefits now. And the first benefit is limited liability. Again, as we mentioned before, where you have a corporate trustee involved. The next one is income splitting. Income splitting means that you allocate various percentages of the profit to various entities. For example, you can allocate a profit to a company, to another person, to another trust, whether that be a discretionary trust or a unit trust. You can, have a mix of distributions, okay? The only limitation with this is personal services income, PSI. And what PSI is, and that needs a video all on its own. PSI really is, quite simply, the person who earns the revenue is entitled to that revenue. For example, think of an IT professional. If they earn all the revenue, then that revenue must be passed on to them. It can't be distributed to anybody else, right? The tax law does not allow that, okay? Now, the next one is income streaming. What is income streaming? Income streaming means you're able to categorize various types of income that are coming into the trust. For example, you have dividends, frank dividends, or maybe just dividends. You have capital, and then you have revenue. So you're able to split those types of income and provide it to the relevant beneficiary. A good example of this is where one of the beneficiaries has a capital loss. When you distribute the capital gain to that beneficiary, they're able to offset, reduce that capital gain by the loss they have in their own name, and therefore they're able to reduce the tax paid on that income. The next one is the tax rate. Well, we mentioned before that the tax rate can be all the way up to 47.5% thereabouts, which is the highest marginal tax rate plus Medicare levy surcharge, where there's no income that's being distributed to any beneficiary. So it's really a penalty. But the benefit here is that when you distribute to various individuals or entities, then you really leverage the marginal tax rate of that particular individual or that particular entity. For example, corporate tax rate can be 26% or 30% at the time of making this video, depending on the type of company and the activity. Okay. Now the next one is the 50% CGT discount. That's the discount you can access where you've held an asset for 12 months or more. Now it's important to remember that it's 12 months or more from the date of signing, the date of the contract. Moving on to the next one, the small business entity CGT concession. So what are we talking about here? We're talking about the 15-year exemption, the 50% active asset reduction, the rollover, and the 500,000 superannuation discount or exemption. Right now, this is a very, very complex area and it needs time to itself. Needs a topic, needs a video to itself. All right. Now, the last one is franking tax offset. When you have a franking credit attached to a dividend and you stream that across to another entity, you are able to get a tax refund where the ATO owes you that amount. Now, it depends on the entity. With the company, generally, there's no franking credit refund. But again, that's something that's quite complex and it needs a topic on its own. As always, I hope this video has been helpful to you. Please hit the subscribe, hit the bell button so you receive notifications of the videos as they come out. Leave a comment in the comment section letting me know what your thoughts are. Provide feedback to let me know what topics you'd like me to discuss or maybe something that I could be improving on with the videos. I always love to hear the feedback. Thank you again for watching and we'll see you on the next video.